You can be approved for the mortgage and still lose a Chicago condo because the building doesn't work for the loan. That's what buyers need to understand about these new condo rules. As of August 3rd, Fannie Mae and Freddie Mac changed how many condo buildings are reviewed. And here's a Chicago twist. A 6-unit walk-up may be treated very differently from a large high-rise. So before you get attached to the unit, you need to know whether the building itself can work with your financing. Here's the simple version. Many conventional mortgages are eventually sold by the lender to Fannie Mae or Freddie Mac. And those organizations have requirements for condo buildings, not just requirements for you as the borrower. Starting on August 3rd, Fannie Mae eliminated its shorter limited review process, and Freddie Mac ended its similar streamlined review process for new applications. So some condo buildings that previously received a lighter review may now need a deeper look unless they qualify for another review option. And one important distinction, this video is about conforming condo loans intended for sale to Fannie Mae or Freddie Mac. Now here's where Chicago gets interesting. We have 3 flats, 6 flats, 8-unit condo buildings all over the city. And these smaller buildings aren't automatically treated the same as a 100-unit high-rise. Fannie Mae expanded its waiver to qualifying condo projects with 10 units or fewer. In plain English, some smaller buildings can avoid the deeper, full review entirely. Chicago SIFLAC is automatically easy to finance. For buildings with 5 to 10 units, there are conditions. For example, being a part of a larger master association can change the rules. And your lender can still require more documentation than Fannie Mae's minimum requirements. I actually spoke with the Chicago area lender who told me their company is reviewing smaller condo buildings more aggressively. That's one lender's practice, not a rule for every lender, but it's exactly why I wouldn't assume a small building gets a free pass. Now let's clear up the reserve part because there are 2 different dates getting mixed up together. A condo association normally sets aside a part of the money it collects for future repairs. Think roof, elevators, masonry, plumbing, or garage work. That's the reserve fund. Beginning January 4th, 2027, Fannie Mae raises the minimum required contribution under the review from 10% to 15% of the association's annual assessment income. So that 15% rule did not begin August 3rd. Something else did change in August. If a lender relies on a professional reserve study instead of the normal budget requirement, Fannie and Freddie now requires a more conservative approach to how much that study set should be funded. For a buyer, you don't need to memorize the accounting rules. The point is that the lenders are paying closer attention to whether an association can put enough money aside for future building expenses. This is where I think condo buyers can get fooled by the listing. You see one condo with an $800 monthly assessment, and I think that's expensive. Then you see another building charging $200 a month and think, well, that's obviously better. Maybe, maybe not. A low HOA doesn't tell you whether the building has enough money saved. A high HOA doesn't automatically tell you that the building is healthy either. What matters is what's behind the number. How much money is being collected? What's being saved? What major repairs are coming? Has the association been putting work off? Because if a building keeps assessments artificially low while expensive repairs pile up, somebody eventually has to pay for those repairs. And that can mean higher monthly assessments or a special assessment later. What can the lender find that creates a problem? Depending on the type of review, they may look at the association's budget and reserves, building insurance, unpaid assessments from owners, special assessments, major lawsuits, and serious repairs that haven't been completed. And here's what's frustrating for buyers. You usually can't see anything during a showing. You can love the new kitchen, you can love the balcony. The condo can be 2 blocks from the train, and none of that tells you whether there's a financial or building issue sitting inside the association documents. Even a smaller project that qualifies for Fannie's waiver doesn't get to ignore every requirement. Insurance and basic property eligibility still matter. So when I say that a building can kill the financing, this is what I'm talking about. So I'm not telling you to request a stack of association documents before every condo showing. That's not realistic. But once you're serious about a property, stop evaluating only the union. The association becomes part of the purchase too. You want to understand the budget and reserves and find out about current special assessments. and major repairs the association knows are coming. And get your lender involved early enough to determine what kind of review that particular building will require. One question I would specifically ask your lender is, what condo review will this building need for my loan? That's a much better question to ask early than discovering a problem a few days before closing. And this is why when I'm helping someone buy a Chicago condo, I'm not looking only at whether you like the unit. We need to think about the building, the monthly costs, whether it works with your financing, and if you're relocating to Chicago, buying your first condo or moving within the city, there's a link below to schedule a real estate consultation. Go below, and we can talk through your budget, the neighborhoods you're considering, and the type of condo building that fits your situation before you start writing offers. And don't take this video as me telling you not to buy a condo. For someone who wants a walkable Chicago neighborhood near transit, a condo may still make far more sense, financial sense, than trying to buy a single family home in the same location. Just remember this, getting yourself approved is only part of buying a condo. You need to find out whether the building works for your loan too. And if you're comparing condos and wondering why the cheaper one may not actually be the better deal, watch my video on the strange math behind cheaper condos. It's currently right on the screen.